Right now, inflation is pretty rampant, and it doesn't look like it's going to let up anytime soon. What do people misunderstand the most about an inflationary environment?
This is Trillions ETF Master Chef, where we interview the chefs of the finance world on their hottest investment recipes.
Welcome to Trillions. I'm Eric Balchunas.
I'm Scarlett Fu.
Scarlett, we have a Master Chef on today that has a portfolio that involves probably the biggest word of the year.
It's inflation, and it's taken over. We're here with Nancy Tengler. She is CIO of Laffer Tengler Investments in Scottsdale. And Nancy, you have a strategy called the Dynamic U.S. Inflation Strategy. What's dynamic about inflation?
Well, my partner, Arthur Laffer Jr., he developed the strategy about 12, 15 years ago when we really didn't have inflation. But using ETFs, he's able to shift back and forth between different securities depending on where we are in the inflationary cycle.
Who is this strategy for? Who are you cooking it for?
It's meant to be a side dish. So you don't want this to be the core of your portfolio, but you want it to accent your portfolio.
So let's look at the portfolio here. The top holding here, IGBH, which is interest rate investment grade ETF. Explain what that does.
It's meant to be sort of a base anchor for the portfolio. It's corporate bonds with interest rate exposure moved out of the portfolio via options. And so you've got high quality, but you don't have any interest rate exposure. That's something we want in a rising interest rate environment.
On the equity side, you also have exposure through premium income. And why JEPI?
When possible, we're fee sensitive, but our firm manages relative yield, high dividend growing equity strategies. But it uses options to enhance income and also to dampen market risk, which in this environment is important, to say the least.
All right, when someone says inflation, I think gold right away. And there's any number of gold ETFs that you could put your money into, but you've chosen SGOL. Why that one?
Well, because it's focused on spot price versus futures, and it's also one of the cheaper. So all of our commodity exposure is really, ETFs are using options to mitigate contango, and that's important in general, and then just having exposure to the actual metal, that's really the objective.
And let's look at, you've got gasoline and oil. Why have both in there?
The objective is to get exposure across the energy spectrum. So natural gas has kind of taken on a life of its own relative to oil this year. We've seen natural gas prices in Europe go up, fivefold or more. In the US, we've hit 8. And then in oil, just to avoid contango, to be in a position to benefit from rising energy prices.
So a lot of people might not understand how you get exposure through these commodities through ETFs, because you also have wheat and corn in here. Explain how you manage that, because that can add costs.
Yeah, and those are some of the most expensive ETFs, but we're quite worried since Russia invaded Ukraine that there will be food shortages. And so in the last 3 months, we added wheat, corn to the portfolio.
And then to top it off, you have 3 theme ETFs, which is interesting. You've got robotics, digital infrastructure, and aerospace and defense. How are those correlated to inflation?
So as a shop, we're research driven. We're bottom-up fundamental investors, but we have an overlay, a macro overlay. The defense stocks were purchased when we began to hear rumblings that Europe was going to rearm. So that's a long-term play. The bots and the VPN ETF were really plays on productivity. So when you're in a rising wage environment, it puts a lot of pressure on the unit labor costs and therefore corporate margins. So we wanted to play the side of it that we think corporations are going to be focused on, which is investing in productivity. And we've done that in our equity strategies as well. We have a lot of exposure to cloud and cyber. This was a way for us to play that component of the inflation story.
Walk us through what demand has looked like for the dynamic U.S. inflation strategy, because as you mentioned a while ago, it looked like, well, just last year we were saying, oh, inflation, that's transitory, it's never going to last.
Yeah, we've received a lot of interest in this particular strategy. For the record, we didn't think it was transitory, inflation that is, and so we positioned the portfolio early on to benefit away from fixed income securities and more actively managed. And we also own the VIG in here, which is dividend growing names. And so one of the ways you offset inflation is through dividend growth. It also provides protection in a declining market. So the strategy actually has a positive return, or did through the second quarter. That shows the lack of correlation to U.S. equities and to fixed income. And that's really what people are searching for.
Big picture, when you take a step back and you talk to your advisors and your clients about inflation and how to position yourself when inflation is rising, what do people misunderstand the most about an inflationary environment? What do they get wrong all the time?
I think they assume that it's bad for equities, but actually inflation is an environment where equities, which are ETFs as well, can do very well. And so we've tried to educate our clients and the advisors that use this particular strategy that because it's dynamic, it can perform well in every environment.
Nancy, thank you so much for joining us. It's been a pleasure.
And thank you for joining us for this latest edition of ETF Master Chefs.